Hello, everyone. A little practice with corrections as opposed to adjustments. Here with Unger Retailers, we have found certain errors during a 2018 audit that occurred during, at least some of them, during 2016 and 17. None of them were corrected previously, and we're going to be disclosing all 3 years, okay? And then any journal entries that need to be made in 2018. So 2016, 2017 are closed. 2018 is still open, meaning we can make journal entries for 2018. All right, but we don't make journal entries for 16 or 17 because the general ledger is not available to make journal entries there. But if there need to be corrections, they must need be disclosed in the financial statements and corrected there. So this first one, beginning inventory in 2016 was understated. Now this is only going to affect 2016, assuming that 20 ending year and the subsequent inventories are correct. This is only going to affect 2016. It would have affected also 2015, but we're not worried about that. So we need to make a correction there. So if we look at that, we'll have to correct our disclosure by increasing cost of goods sold, increasing retained earnings in 2016. And as well as the inventory on the balance sheet. So all of those will be corrected in the disclosure. Nothing will happen in 2017, and no journal entry is needed in 2018. So this is only a disclosure issue. Actually, this doesn't affect just retained earnings because retained earnings for 2015 would be wrong. But the inventory is not corrected. I was mistaken. This disclosure by, just as it says here, the cost of goods sold in 2016 and retained earnings. Merchandise costing $2,400 was sold for $4,000 in December 2016, but it was recorded in 2017. It was shipped. FOB shipping point was not included in any inventory. That means the inventory is correct at the end of 2016. So cost of goods sold is correct, inventory is correct. So all we're worried about is the sales amount. And so we're going to correct that disclosure in 2016 because it should be in 2016. We should increase sales and accounts receivable. Those are the offsetting things. Now, of course, any increase in sales is also going to increase retained earnings, okay, on the balance sheet. So anything we do to the income statement is also going to affect the balance sheet in that regard. So that's what the disclosure will be. Again, not a journal entry per se, although you need to make sure your financial statements still balance. 2017, again, we're going to correct disclosure by reducing sales because that's where the sale went. So it needs to be reduced, and retained earnings, because it was increased in 2016, will need to be increased in 2017 because nothing we do in 2016 carries over to 2017 because of the way we're not making journal entry, we're not changing the general ledger. Disclosure here doesn't carry forward to disclosure here in 2017. Nothing in 2018. 2-year fire insurance policy on 2017 was debited to prepaid insurance. No adjusting entry was made for 2017. Okay, so this is going to affect 2017 and 2018. No effect on 2016. We're going to correct our disclosure in 2017 by increasing insurance expense and decreasing prepaid insurance, which of course that change in insurance expense is going to affect retained earnings. And we see that because nothing we did over here to correct this disclosure carries forward because we didn't make actual journal entry, we have to go ahead and debit retained earnings for that 1920. Okay, credit prepaid insurance. By the end of 2018, it's all used up, and the rest of it is insurance expense for 2018. So this one actually affects 2018, and we need to make a journal entry. All right. Letter D, a note receivable. That means we're owed money beginning October 1st. Payment of 10% note and accrued interest was received upon maturity in 2017. The note amount was accredited to note receivable with the remaining amount credited to interest income. No adjusting entry was made on December 31st. So here's the problem. October, November, December of 2016, there was interest, and none of that was recorded. All right. All that interest was actually recorded in 2017. So both years need to be corrected. All right, at least the disclosure. So we're going to increase interest income and interest receivable for 240. That's 3 months of interest on that note receivable in 2016. In 2017, we need to decrease the interest income because that was recorded in 2017 and it shouldn't have been, and increase the retained earnings for the amount that was carried over from the year before. So we're going to then make no journal entry in 2018. So that was the two disclosures. Again, no journal entry. All right. And our last correction, equipment with a 10-year life was purchased on January 1st. No depreciation for 2016, 2017. And then we'll assume also we need to do 2018. But we can make that as an adjusting entry. So let's look at what we need to do to correct 2016. We increased depreciation expense and accumulated depreciation. That reduces our assets for 3920 for 1 year of depreciation. In 2017, depreciation expense is affected. Accumulated depreciation now is total 7840. Okay, so we need to increase that. Remember that this correction doesn't carry over, so in this year we're going to have to increase accumulated depreciation, increase depreciation expense, and deal with retained earnings to make it balance. And then finally, in the third year, now that we missed three, we can catch up. And this because the asset is still with us. We still haven't sold it. It has not self-corrected. So unlike inventory errors, this is not self-corrected. So we need to catch up the depreciation and accumulated depreciation, but only the 2018 depreciation should be in depreciation expense. The 2016-2017 depreciation is an adjustment to retained earnings. And just a reminder on the statement of equity, this should be an adjustment to beginning retained earnings for 2018 if that were the only year that we were disclosing. That's how you would disclose this. So this actually requires a journal entry because the asset is still on our books. There needs to be a catch up. This is not reversed. And if you don't fix it here in 2018, it will continue to be wrong going forward. This accumulated depreciation needs to be caught up. So any asset that's already been sold or something, most of the time that has been self-correcting, and therefore making an adjusting entry or a correction entry would actually make things worse because it self-corrected. That's why it's important to understand which of our errors are self-correcting and which ones need to be taken care of in the current year.